Salary compared to hourly, how is that calculated when qualifying for a mortgage? Well, are you wondering how income is calculated when qualifying for a mortgage? Whether you earn a salary or an hourly wage, you are in the right place. Understanding how a loan officer views your income is key to determining your qualification and ultimately, wait for it, your buying power. So let's dive in. Hey guys, my name is Gavin Sessions with Loans Made Simple. If you are curious to learn about all things related to mortgages and home loans, subscribe to our channel. We post new content regularly. If you're ready to get qualified for a home loan or need to get connected to a great real estate agent, our contact information is in the description below. All right, let's jump into this. So how do lenders calculate your income? So before we explain the differences between salary and hourly income, let's share how a loan officer will determine your qualifying income. So a great loan officer is gonna think like an underwriter, and frankly, it's their job, right? And underwriters are always looking for a warm, fuzzy feeling, and that might sound weird, but they're always looking for a warm, fuzzy feeling to determine your qualifying income, right? The number one thing they're required to confirm is that your income is two things. Number one, that it's stable, and number two, that it's continuous. So if you've ever watched any of my other videos or had a conversation with me on the phone, you've heard me say that over and over and over again. We're gonna harp on stable and continuous. So stable means it's consistent from month to month, and continuous means that it does not have a defined end date for at least the next 3 years. So you might be asking, what kind of job has a defined end date? Well, think of contract employees, seasonal workers, construction projects, etc. So if your job has a defined end date prior to 3 years, it would be considered not continuous and therefore not eligible, most likely. All right, so quick pause here as I've used two terms that you may not even be familiar with. So the first one is a loan officer, and that's a customer-facing salesperson. Basically, it's me that offers you a mortgage loan. And an underwriter works for a lender and sits behind the scenes, and they're gonna evaluate your loan application against the program guidelines, right? So whether you're getting an FHA or a conventional or a VA or whatever possible loan you might be interested in, it has guidelines, and the underwriter's job is to make sure your application meets those guidelines. So the key factors that underwriters are looking for are a few things. The first is length of time at your current position. So you must have at least a 2-year work history. So in mortgages, I'm always putting my 2 fingers up because oftentimes we're looking for the rule of 2 across the board. So in this case, we're looking for a 2-year work history, ideally in the same line of work, but it doesn't necessarily have to be at the same line of work, nor does it have to be at the same job. Also, quick tip here, education, such as being a college student, can count for work history. So if you recently graduated and have only been on your new job for a few months, we can use your college education time as work history. So hopefully that helps. So underwriters are also very interested in the type of income that you earn. And typically that's gonna be salary or hourly, right? If your salary, it's super easy, right? That's an annual amount of income divided by 12 months, super simple. If you're hourly, it's a little bit harder, but it's still pretty simple, right? We're gonna look at the average hours you work per week, per month, and per year to determine that qualifying monthly income. You might also earn other types of income. Maybe you earn overtime, bonuses, or commission. So those are all things that the underwriter is going to evaluate. So another quick pause here. If you're watching this video, you're likely not self-employed, but maybe you are. And if you are, I'd love to invite you to stick with us, as I'm confident this will still be valuable for you, and we're gonna point you to other helpful videos along the way. All right, so now that we're done with that introduction, let's jump into salary first, and we're gonna use Emily's story to illustrate how this works. She's one of our past clients. So another thing that you'll often hear me say, whether it's on camera or whether it's in a conversation that maybe we've had, is that salaried income is really like a silver bullet. It's super straightforward, and underwriters love it for that reason. So all they do is take your annual salary, they divide it by 12, and that determines your monthly qualifying income. Simple as that, right? Even if the hours you work fluctuate slightly from week to week, it doesn't matter because your pay never changes, right? Every pay period you receive the same amount of income, which makes salaried income the definition of stable, so long as it does not have a defined end date within 3 years like we talked about, right? Then it's both stable and continuous. All right, so let's get back into Emily's story here to make this as practical as possible. So she's worked as a marketing manager at a software company for the past 18 months, that's a year and a half. She's earned a salary of $72,000 per year, right? So prior to that, she worked at a part-time job at the same company in a lower level support position where she earned $20 an hour. So even though Emily hasn't worked at her current job in, being paid salary for at least 2 years, the salary pay type that she's currently earning allows us to ignore the income that she earned in the past, right? But still use the work history to prove sufficient work history. All right, so you may have caught on that Emily hasn't worked as a salaried employee for at least 2 years, but in this case, that actually doesn't matter, right? Because that salaried income is both stable and continuous, and we can use that for her qualifying income right away. But we still need to prove that she has a 2-year work history. So we'll go back and we'll use the previous position she had to complete that 2 years of history. Hopefully that makes sense. All right, again, making it more practical, to determine Emily's monthly qualifying income, we're gonna take that annual salary of $72,000 and we're gonna divide it by 12 months to come up with qualifying monthly income of $6,000. All right, so Emily's current salary makes her income both stable and continuous, both things the underwriter has to prove, and no additional calculations are needed. So in this case, she checks all the boxes for qualifying income and we are ready to move forward. All right, so you probably get it, salary is the easiest, right? But what if you don't work a salaried job? Does that mean you're hosed? No, definitely not, right? A lot of people work hourly jobs where they get paid per hour, and I'm so glad you asked that question. So if that's you and you get paid hourly, we're gonna look at the average hours that you work per week and your hourly wage to determine your qualifying income. So generally, we're gonna use the following method, right? We're gonna take that hourly wage, we're gonna multiply it by the average hours you work per week, we'll multiply it by 52 weeks in a year, then we'll divide by 12 months, kind of wordy here. Hopefully we can see this on the screen super clearly, and then that will determine monthly qualifying income. Again, wanting to make this so practical for you, let's look at Emily's husband, Jake. So he works as a medical assistant, earning $25 an hour, and he consistently works 40 hours per week. So his income is calculated pretty simply like this, right? $25 an hour, 40 hours in a week, 52 weeks in a year. We go divide that by 12 months, and that gives us a monthly qualifying income of $4,333. I hope that is simple and makes sense. So let's get into a question that we get asked all the time by borrowers. What if the hours that I work vary from week to week or month to month, right? Maybe some weeks I work 40 hours, but others I only work 30. So underwriters consider that to be fluctuating income, and we really don't love that term in this industry as it requires us to look back over a full 2-year history to get an average of your total earnings over that time, right? And that would help us understand what your stable monthly income is. So if you're an hourly employee, it's our recommendation, if it's possible, for you to work as consistent hours as possible from pay period to pay period, right? The less fluctuation, the better. Hey guys, before we wrap this up, there's probably a couple of additional questions. Maybe you find yourself earning overtime, bonus, or commission. I know it wasn't part of your original question, but it's likely you're thinking about it. So let's take maybe a couple minutes here and cover it. So overtime, bonuses, and commission income can be used to help you qualify, but the underwriter will typically require receipt of that for at least 2 years to establish an average, right? So what they're gonna do is, like a fluctuating hourly employee, they're gonna sum up the total amount of income that you've earned over a previous 2 years and then divide it by 24 months, right? So if you've earned commission for the past 2 years, it's that total commission received over 24 months divided by 24 months to determine what your qualifying commission income would be. And that's also true for a bonus or for overtime. So quick example here, if Jake earned $5,000 in overtime last year and $7,000 in overtime this year, he's basically earned $12,000 in overtime over the last 24 months. We divide that by 24 months, that gives us $500 per month of overtime. Hopefully that makes sense and it's pretty straightforward. Quick hot tip here, FHA is much more lenient on this than conventional, right? So maybe you've been a bartender for the last 18 months and have not earned tips, which would be considered commission for at least 2 years. Well, the good news is FHA will allow you to use tips as a qualifying income as long as you've received it for at least 12 months, but it also has to be highly likely to continue. And in the case of a bartender, it would almost certainly continue. So you'd be in good shape from that standpoint. Hopefully that makes sense. All right, now you know the difference between salary and hourly qualifying income and how we determine what that is. So if we didn't answer a specific question that you have, or if you're thinking about jumping in and buying a home or needing to refinance, we would love to have a conversation with you. Scroll down, find our contact information. Again, we'd love to help and we'd be so honored to help your family. If you thought this video was helpful, give us a like. Then subscribe for more mortgage tips, and finally, drop us a comment below with your specific questions. If you're ready to learn more, click here to watch this next video and we'll see you on the next one.